Hey, good afternoon, everyone. David Grau Jr. here, president of Succession Resource Group. Excited to have you join me here today for our session titled The One Thing. I'm going to be sharing with you, as the title implies, one specific thing that we've observed and sort of learned in the market for buying and selling businesses just like yours over the last couple of years. The one thing that I'll just call them stakeholders, the home office personnel with your broker dealer, home office personnel with your favorite custodian or least favorite custodian, coaches, consultants, recruiters, everybody out there when it comes time to sell wants to help you, but there's one thing that they all have in common that they all do consistently that we're going to talk about here today that really has an impact on the value of the business. We've got the session here today online, so if you have any questions as we're going through the content here, I will be keeping an eye on the questions portion on the computer. So let me know if there are questions that come up. Otherwise, I'm going to dive in. Hopefully everyone can see the slides here this afternoon. So a little bit about SRG and what we do. So we are a consulting firm that handles mergers and acquisitions for independent financial advisors. I see a lot of you that are registered, we've worked with, we've talked to before. So no big deal, no surprise. You are probably familiar with us. If you're not, like I said, we work exclusively with independent advisors on valuing, buying, selling, and depending on how you differentiate selling, I'd say also succession planning, internal transition planning with key team members, key staff members, family members. So that's the focus of our work. The data I'm going to share with you here at the very beginning is just meant to set up the conversation that when we talk about, the one thing that happens out there consistently for advisors in the sale of their business and that really tends to diminish the value of the business. This isn't just simply observation or opinion. What I'm going to share with you is our observations. We work on deals of, I don't want to say all shapes and sizes, but we work on a pretty wide range of deals. Some where we're simply acting as an intermediary. We're helping buyer and seller work, together on their deal. Other arrangements, it is more sell side, where you've got an advisor who's ready to retire, and I'll have to put quotes around that since you all can see me. They're ready to retire, but they want to stay involved for another couple of years, and they need somebody to help go find them a buyer, negotiate. So we do all of this stuff, and from that data, we can then come back to you, and every year in January, February, we publish our data, our multiples, the deal structures, what's happening out there, buying and selling practices just like yours. So that's my focus here that I want to share with you. To start with, before I get into answering the specific one thing that we see just killing advisor value and valuation, I want to start by covering the value. If you haven't attended one of our sessions in the past, well, then it's worth at least establishing what are the going rates for buying and selling these businesses. And before I can even get into that, we've got to talk about what are you actually buying and selling? And so that's my first slide here, and that is what are you actually selling, or what will you be selling? If you're a buyer, what are you buying? And I've drawn the line in the sand here. Are you buying a business or a book of business? One's not better or worse than the other. They're just two very different things from a value perspective, from a deal structuring perspective. And so, as you read the trade publications, for example, I just came back from the Pershing Insight Conference. I was at the TD conference, and I've been to a handful of others in the meantime. There are always sessions on valuing and buying and selling because the industry is getting older. There's a lot of succession planning happening, not nearly enough, but there's a lot more of it happening now than there was 5 and 10 years ago. But the conversations are always focused on sort of the debate of, if you're going to talk about value, do you use gross revenue multiples? To talk about value, do you use earnings-based multiples? And there tends to be two sides, and they are very polarized, like all politicians, for example. And the answer isn't one or the other. It really depends on the circumstances. And I've developed those circumstances on this slide for you to simplify it. If you are buying a business, you should really, as the buyer or seller, focus on the profitability. And I'll share those multiples with you. The multiples of earnings, EBITDA, the net income multiples, bottom line. If you're selling a book of business, I don't care if it's a $100,000 book of business under an IBD or a $100,000 book of business as an independent RIA, or a $5 million book of business. If what you're selling is clients and revenue, it's assets. And yeah, maybe the buyer will pick up a few key staff. That happens a lot of times for bigger businesses. But if they're not buying the turnkey systems, processes, office that you built, the office I'm sitting in here today, for example, then you really focus on a book of business. And the answers for valuation are very different. So that's what I want to share with you here on the next 2 or 3 slides is what is your value? If I'm going to talk about the one thing that's killing the value of your business, and most of the time advisors don't even know it when it's happening, we got to all be on the same page with what the value of your business is. So what is the value? What I've started with is the simple multiples of revenue. These are the recurring multiples you'll see in blue here. I'll highlight it for you. And then below that are the commission or transactional multiples. So on average, we get this question, I mean, literally almost daily at this point. Nobody's asked it quite yet today, but I'm sure it'll come. What is a business worth? What's a practice worth? If you are selling a book of business and the focus is not on selling an entire turnkey operation, 2.68 would be the average multiple of recurring revenue. So it's fees, trails, 12B1s, insurance renewals, financial planning, to the extent that you A, charge for it, and B, do it every year for your clients. Those would all be recurring revenue sources. The commissionable stuff is 0.88, and you can see the line here going back to 2013, definitely trending down. We expect that to continue. But these are the average multiples. What you'll see here on the screen then is taking and looking at the range of multiples because they are all over the board. You can see plenty of deals are happening north of 2.5 and plenty of deals are happening south of 2.5. And I've given you some simple answers here. Optimized book of business, less optimized would certainly be lower. Clawbacks and contingencies built into the deal. These are all things that impact the value. The alternative then is if you're selling a business, regardless of size, but if you're selling a business, then we've got to focus on the earnings multiples, which tend to range in the 3 to 8 times spectrum. And I put a few examples off to the left here. Client age, your client's age, the client tenure, growth of the practice, growth of the revenue, the clients, and the assets. Looking back over the last, usually buyers and sellers will look at the last quarter, the last 12 months, and then usually the last 3 to 5 years to assess growth rates. Turnkey operation, average fees charged, and then location of the business. And you can see here, I've given you a few examples of, if it's a turnkey office, yes, you're going to be at the higher end of the range. The answer is no, you'll be in the lower end. Hard part is, can you stay at the higher end of that range on a multiple for having a turnkey operation without killing your profitability? And it's a tricky dance. But these are things to be cognizant of. So selling a book, stick to top line, which is most of the advisor population. And I'm telling you, anybody doing less than probably 3 or 4 million in revenue annually, independent fee only RIA or advisor under an IBD, you're probably going to sell a book of business unless you sell internally. The larger firms, it can go 50-50, but keep it in mind. So with that in mind, then what's the one thing? So I just talked about what the average multiples of revenue are. I talked about the multiples of earnings, so you at least have those as your baseline. So what's the one thing, since our focus here is to try to give you a very specific answer in a short amount of time, to keep this on your radar? The one thing is assuming demand and interest in your practice equals value. I'll elaborate. So finding an interested buyer, honestly, at this point, that is not the issue. For those of you that have not been through that process before, and I assume most of you have not, because if you do this right, you're only going to sell the business once. When it comes to selling the business, you will have a lot of demand. The key here is you can see my illustration here, and I think you probably get the point. When you talk to folks, let's say you're affiliated with an independent broker-dealer, or you're under a custodian or a couple of custodians that you use for your clients' assets, you call any of those folks at home office and tell them you're looking to retire, sell, maybe transition out of the business, not immediately, but in the next 12 to maybe 36 months. The first thing they will tell you is, you know what? There's going to be a lot of interest in your practice. I know 6 or 7 people that I can introduce you to. I mean, this literally happens all the time. And it doesn't sound like a bad thing on the surface. I had a conversation this morning with a good friend, longtime coach, consultant, does very well with his clients. Used to be at a home office for a well-known independent broker-dealer, and then went out on his own. And he was telling me about a scenario, East Coast client of his that we both worked with in the past. Same thing happened. He's now thinking about transitioning out and maybe selling the business, sticking around for a few years. And he called up one of the very well-known recruiters in the industry, somebody he'd worked with years ago. And sure enough, she said, yeah, you know what? I've got 7 great people with your broker dealer I can introduce you to. That is the one thing that will kill that advisor's value. And it doesn't have to, don't get me wrong. But what I mean by kill his value is he's assuming that when that individual refers him 7 candidates, that person knows the market and those buyers are all going to play fair. And that just isn't the case. The individual in this case, the recruiter, but it could have been a home office person, could have been a coach or consultant. They're trying to help by providing 6 or 7 or even 10 candidates. And sometimes it's as few as 1 or 2. But they think they're solving the problem by introducing you to folks that would be interested. If you don't believe me that finding the interested parties is not the issue, test me. Put a post on LinkedIn when we finish up here in the next minute or two. Put a post on LinkedIn. Just put the hook in the water. Say you're looking to sell your business and contact you if anybody's interested, and watch what happens. I don't care if you do that on Facebook, LinkedIn, your blog. If you put it there, I can guarantee you will find people who are interested. That is not the issue. And frankly, when you talk to folks at home office, whether it's the custodian or the broker dealer, even TAMPs, this happens sometimes with, not the better ones, but the ones that are trying to sort of, you'll see my graphic here, put the walls around you. Their focus is not helping you, not getting you the best buyer, not getting you the most value. Their focus is keeping the assets. You already knew that. And they'll tell you that. They'll disclose it. Obviously this isn't altruistic. They want to keep the assets, but they also want to try to make sure they can get you connected. There are a lot of interested buyers. The point is not to find the buyers. It's once you have found them, what do you do with them? How do you negotiate? How do you keep everyone interested in play? And how do you find everybody that could possibly be a good fit? Because I tell you, your home office contacts, your coach or consultant, they are going to know a segment of the market. We need the whole market. And then we need to know what to do with that market. So that from our perspective, whether you worked with us because we do sell side representation, if you're larger and outside our scope, work with one of the investment bankers, honestly, I don't care who it is, but get somebody on your side when you sell. That's the one thing you've got to do. And again, really agnostic of who it is, would love for it to be us. But the key is you're only going to ever sell your business once. And I want to make sure when you sell it that first time that you get it right and you're not going to have any do-overs. So the key is really to make sure that you have exhausted the buyer pool, which is what you'll see here. Get the sell side support, somebody who knows the market. They know these buyers. Because in my example, the coach that I was talking to this morning that called in about his East Coast client, that wasn't a stupid advisor on the East Coast. He's very knowledgeable. He's built a wildly successful business by any measure, 2 million something in fees. But he's talking to 6 or 7 potential buyers that are interested. And of course, he naturally is flattered, assumes that will be sufficient. And it might be. But I would tell you, of the buyers he's talking to, I knew half of them. They are very experienced buyers. And those buyers only do deals when they win. And in these deals, anybody who tells you they're trying to create a win-win hasn't done it before enough, because there are only one winner and there's only one loser in each and every deal. Now, we can try to keep those things balanced, but a good deal for you as the seller means a less good deal for the buyer. But you can still find ways to make it a win-win. But you got to find the right person, and you got to have enough demand that when you're negotiating with the right person, there's actually 4 or 5 right persons at the table. And that's the point of this illustration here is, yeah, don't get me wrong. Fit has to be first and foremost. But there is enough demand out there in the market currently. You can sort of have your cake and eat it too. You can stay, if you want to stay with your custodian, keep all the assets there. You want to stay with your favorite TAMP. We had a really good seller here in the Portland market that was a big advocate fan of AssetMark, who actually referred him over to us originally. there's enough demand. We were able to establish the seller's criteria. The buyer had to use or already use AssetMark. And once you know that, then you can create a pool of buyers that's large enough. You can get the right fit, the right value, and the right terms. The challenge is when you work in a system like what you see on the screen here, where you have folks trying to help you that consciously or subconsciously have conflicts of interest, the last thing they want to do is introduce you to somebody who might be your perfect buyer, but that's affiliated with a different broker dealer or uses a different custodian or doesn't even use a TAMP. They do all in-house money management. Might be the best buyer for you, your practice, your clients, but there's not a chance they're going to introduce you to them. And the key is if you do this right, what the TAMP wants, what the custodian wants, what the broker dealer wants, what everybody wants is to keep your assets, keep your business where it's at now. And there's no reason that has to change, but you don't have to sacrifice 20, 30% of the value of your business to accommodate that outcome. So that's our one thing for today. We got lots more one things that would impact the value of your business, but this one just keeps coming up where advisors will talk to us and say, yeah, you know what? I'm going to see how it plays out with these, 3 or 4 candidates that I already know. And then if that doesn't work, then I'll end up calling you back. And inevitably, they either end up calling us back after spending a lot of time and effort and not getting anywhere, or they don't. And I can guarantee you, because we get hired to help act as the intermediary on a lot of those deals, they are literally leaving tens of thousands, sometimes hundreds of thousands of dollars on the table. And maybe that's not your priority, but I can also tell you because they didn't exhaust the market, they don't even know if they have the perfect buyer. They just sort of took the path of least resistance. And I think honestly, if we do this right, you can quite literally have your cake and eat it too. We can get you the perfect fit. You can get the best value, and you can get almost all cash or all cash at closing. You don't have to pick from one of those three. And that's what I think a lot of advisors have been led to believe. So I hope you found the information useful. You'll find as we get into the content on future webinars, we'll continue to push this stuff out. So stay tuned. We will share the next webinar that we've got coming up with you. One of the questions we had here from Rich, good question, so was how do we download the slides, or can we download the slides? For those of you that have registered and attended, we will get you copies of the slides. More importantly, hopefully, the replay will be available and you'll get to see these slides as well as me talking. Win-win. So we'll get the slides to you. I think at this point, those are all the questions we had. We are live, so if there are any other questions, let me know. You'll see off to the right-hand side here, we've got the panel where you can actually click the links to check out, LinkedIn, Facebook. We're pretty active there in pushing out the information on like the next webinars, interesting findings. We actually had some really interesting stats that came across my desk today that we'll be pushing out. So stay tuned. One more question. Looks like we've got an advisor that is curious on whether we only represent the seller. And you can actually see that question here from Michelle. So great question. No, we don't only represent the seller. It's hard. I would equate this to, I equate a lot of things to real estate because we're all familiar with it. But I'd equate representing the buyer, for example, to representing a buyer in like a hot real estate market. Frankly, Portland. I mean, I don't know about your markets where everyone's at, but representing a buyer in a hot real estate market kind of feels like you're not really representing them, because the answer most of the time, Michelle, would be, well, if you want the deal, I would recommend you increase your price, which doesn't feel like buy-side representation. But the short answer is yes. We can certainly help represent you as the buyer. You have to sort of take that into consideration. But there are still ways, especially depending on who's on the other side, there are ways that you can ultimately still win the deal, even though you might give the seller what they want on value. There's a lot of other considerations, the price, the payment terms, the taxation and structure of the deal, seller's compensation. And because we have so much data from doing these deals, we can usually still help you get a pretty good and fair deal without losing it. One of the other questions we just had come in was annual numbers offering the market metrics, PowerPoint, PDF. We have both. We can get you over, Kurt, a copy of the infographic. We publish just a really simple infographic every single year that has the multiples that I talked about, the multiples of recurring revenue, multiples of non-recurring revenue, but it also has a lot of information on the highest multiples that we observed. It's got the deal structure, so a lot of good information. So we're happy to share that with you and anybody else. Next webinar that we've got coming up, last thing I'll share, unless anybody else had any other questions, is effective strategies for exiting your business. So similar topic to what we talked about today, but instead of talking about the one thing that would be detrimental to your value, making sure you're aware of it, here we're actually going to get into specific recommendations that whether you're selling internally to a family member, whether you're planning to sell externally to a peer, maybe a merger, internally to key team members, we're going to touch on some really key strategies that we've seen work well for each of these scenarios. Obviously, everybody's succession plan is going to be a little bit different, but at the end of the day, there are some, if you back up and squint your eyes and look at the data, which is what we get a chance to do, there you can definitely see some trends on what's happening out there with succession planning. When people are starting the transition plan, how compensation's being adjusted, because that has a big impact. So we'll be sharing that on the upcoming session, which you can see the link over here in your sidebar. So at this point, I'm going to go ahead and wrap things up. Really appreciate everyone joining us here today. Like I said, if you have any interest in the specific strategies for effective succession planning, join us for the upcoming session. I think that is here in just a week or two, so not too far off. Thanks, everybody. Have a great afternoon.